What's one good thing you can tell us about the economic outlook for 2010?
The best thing I can tell you about 2010 is it's not going to look like 2009. The last time we were here in D.C. meeting at the GAC, the economy was in a tailspin, we call it. Credit markets were frozen. The unemployment rate was rising and rising rapidly. We had, in January of last year, lost 750,000 jobs in that 1 month, the greatest monthly job loss of all time. The equity markets had plummeted. Consumer confidence was at an all-time low. And it really felt like the system was coming apart at the seams. We had just learned about the corporate crisis. So 2009, especially early in 2009, things didn't look good at all. And people were talking about a Great Depression, perhaps a recall. Now, the probability of that was quite low, but it was certainly something that people were talking quite a bit about. As we look forward to 2010, things will be considerably different and in many good ways. We had a month of labor market growth, and the shrinkage that we've seen in labor markets has come down and come down dramatically. So that's going to help and help a lot. And by that I mean it will help consumer confidence. The average hourly work week is expanding, marginally, but expanding. Take-home pay wages are increasing, not by a lot, but enough to make a difference. And that will affect consumer confidence. That will affect spending. As you know, equity markets are up about 70% from their March low. So that's all good news that will affect the consumer psyche, make the consumer more likely to spend money. As you know, consumers represent 70% of U.S. economic activity, and so it's very, very important for them to feel healthy and to feel like they're able to spend money. We've had 2 consecutive quarters now of fairly robust consumption expenditure growth, 3%, almost 3% in the third quarter of last year, and 2% in the fourth quarter. So that's good news, we think that there will be a continuation of that going forward. So what does that mean for credit unions? It means that more than likely the Federal Reserve will begin to raise rates this year. Having said that, we do think in our baseline forecast that the yield curve will remain steeply sloped. The big difference between short and long-term interest rates, and that will help credit union bottom lines. Our baseline forecast calls for average ROA at credit unions of about 50 basis points this year. We think lending growth will increase a little bit from about 5 to about 6 or 7%, 5% last year to 6 or 7% in 2010. And savings growth, which came in at double-digit rates in 2009, are likely to come down a little bit, close to 8%. So sort of a return toward normalcy, not to normalcy, but toward normalcy. Now, with savings growth expected to outpace loan growth in 2010, we do think that loan-to-share ratios will come down a little bit more. We do think that there will be earnings pressures related to fast growth in investment portfolios, but overall, the situation looks a lot better this year than it did